Hey there, everybody. Happy weekend. This is Bob. I'm with my good friend Phil here from Trade Genius. If we thought we scared you before, we're really going to scare you. Three things have happened in the last couple weeks in the market. We're going to show you one of them today. Checkmate for the economy. Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Okay, Phil, this is amazing chart. And you know what's really funny about this is that the people that are talking about this chart this weekend actually have it ass backwards, and they're gonna buy themselves into a major market crash. Please share it. Please elaborate for everybody. It's really wild.
Yeah. All right, let's dive in. So here's a blue squiggly line. And what this blue squiggly line represents in this chart is what happened after 2008 into 2009 in the great financial crisis. And what this represents is when banks have to go to the Fed in a dire emergency and borrow from the Fed's discount window. Okay, the discount window is not used very often. And a lot of times this chart looks flat like it is over here on the left. But when it spikes like this is in times of great financial crisis. We all know what happened in 08 and going into 09, and we all know how the market performed then. So now let me bring you to the present day. We have another gigantic spike. This is the worst signal that you ever want to see if you're heavily long stocks or other risk-on assets, because this is telling you that if we haven't dropped yet, we're going to really start dropping. And so when you zoom out, you can see how this compares to the great financial crisis. Okay. And this emerged in 1 week. This came out after all of the banking crisis stuff reared its ugly head and Silicon Valley Bank. So it's really scary to see this in this state. So now what we want to do is we want to say, okay, well, that's great, Phil. What does that mean? So what we're going to do is we're going to turn on a few comparable graphs, and we're going to see how the market reacted when this happened. This little blip over here wasn't really a little blip, but it was the COVID crash. So again, this appears or this spikes in times of major crisis, major stress in the economic system, in the banking system. COVID, obviously, they just threw as much money as we've ever seen at the problem, and it quickly rectified itself. Whereas in this situation, the Fed's undergoing a tightening cycle. It just raised rates, and we're dealing with this. So it's a little different, and the Fed is actually okay with asset prices going down. So the risks to the downside are extremely high here. But if we zoom in and we look at this is a 1 month chart. So let's just look at a weekly chart. All right, this gives us a little more data to deal with here. So zooming in on 2008, discount window spikes. What happens to the market? The S&P 500 is the green line. We go down, and it goes down from Monday, September 29th, 2008 to its eventual lows in March. Okay. So several months of bear market activity, like real bear market. This was up until this point, similar to what we've seen in this market. You're going down, you're going up, you're going down, you're going up. You know, is it going down? Yeah. Is it like mission critical, like getting real serious yet? Not really, but this is serious. This is like, oh my God, the world's coming apart, you know, getting scary. And we haven't seen that in this bear market, but this is the kind of reaction these stocks will have in this environment. You can even look at the NASDAQ here in purple, you know, very similar. Okay. Gold, right? Now, this is what's interesting. Gold, when we get into environments that we get rate hikes, is usually typically bullish for gold. So, and we're macro on gold and Bitcoin, silver, you know, we're bullish in these environments. But what we want you to be careful about is how they react going forward. And so you can see when we have a rate hike market, which we do here, gold historically does very well and does even better when the rates are cut. Okay. And that's coming. What we've seen with the spike in that window, the Fed discount window, that's telling you that rate cuts are coming. So macro, very bullish. The short term though, you got to be really careful here. And this is why, because if we turn on the gold, yellow is gold. And you can see if we zoom in that gold actually came down with the markets as well. So it's not like it's going to be totally immune. And Bitcoin is acting like gold right now too, and we know that because if we look at the correlation charts, we can see the S&P 500 is down here, here's gold, and here's Bitcoin up here. And the funny thing is the Nasdaq's up there too. So for the first time ever, Nasdaq's acting like gold. You know something's seriously wrong in that picture. Bob and I think it's just because they're all piling into the last of the stocks that are holding up because they have to be somewhat invested into tech, could be part of the fund's mandate, and there's just nothing left except for stocks. Once those go, you're going to see things cut loose. So that being said, Bitcoin and gold kind of correlating the same way. We can even expect Bitcoin to drop too. So I know we've had a nice bounce and it's being a safe haven play like gold, but if this is going to play out the same way, we have to be very careful about the downside. The good thing about that is, though, if you notice what happened in gold over here, it bounced early, way early. It bounced in November of 2008, whereas the S&P 500 and the Nasdaq took all the way till March to get out of here. So, and we can look at what the conditions look like today. Here's the same thing. You've got Bitcoin, you've got gold, and you've got NASDAQ up here correlated, which is very odd. But the market is, here's the green is S&P 500 down here. And now we have the worst warning signal on the planet that's telling you impending doom, basically, because things are not good under the hood. The engine doesn't have any oil and is about to lock up. So pretty scary stuff. And Bob, what do you think going forward here?
Yeah, the thing about the Nasdaq was when we were putting this together, doing our prep work, I think it was just shocking to see that the most risk tolerant asset class in the world would be the Nasdaq stocks and they also rely on the mother's milk of credit, and a lot of their customers rely on credit for them to be at the all-time highs. But there's a chart that we didn't put up showing the breadth of the Nasdaq, and that's what Phil was referring to. We're really down to the 7 generals now, and everybody else is falling off precipitously. So my view is that we'll see Nasdaq catch down the S&P, and I think the S&P is going to fall further because, as you stated, Phil, which was really interesting, is that in the great financial crisis, and even if we go back to the year 2000, is that it took 2 years for them to unclog the plumbing. Great financial crisis, they were aggressively trying to solve this problem, and it took them 6 months to turn the boat around. And then the COVID one was kind of easy because it was really more of a man-made event that they had a quick solution for. But this one is unique in the sense that it's what's called a duration interest rate issue, and they can't solve it unless Jerome Powell decides to solve it at the Fed, and he's resisting that. So I think what's going to happen here is you're going to see massive dislocation in the asset markets, and unfortunately gold and Bitcoin will take it on the chin, but they're going to probably fall less than NASDAQ and the S&P 500, and they're going to come out of it faster. And I put some charts together, Phil. These are more just kind of FYI as we get out of this tightening cycle, if you will, and you get the panic, and then people, this is what I would call the non-bank assets, silver, gold, Bitcoin. I would throw, actually, believe it or not, I would throw the long bond in there because it's really a non-bank asset because you're really banking with the federal government instead of the Federal Reserve. So if you look at this first chart up, this is gold. So with gold here, if you look at the bottom and look at these moves up at the top here for gold, I think the measured move up there is around 8,000 or so.
$7,040 basically.
Yeah. So people always ask me, Bob, where do you think gold's going to go? Where do you think gold's going to go? Well, when they release the Kraken, we're going to see gold, easily triple in price, and silver is going to have even a bigger move. I think I have that up there around $89 or something like that.
The measured move you have on this is almost $127.
$27,
which is wild.
So yeah, and Bitcoin, and Phil knows this. I never predict Bitcoin at a really high price. I have Bitcoin over to $300,000. So there you go, guys. This is what's going to come out of this, because I think what we've done here is we've damaged the confidence in the banking system. I think I don't want to call it permanently, but this is cash in a mattress 1930s style remedies from this. People are going to move their assets away from the banking system in droves. And there's only 3 places. Well, there's 4 places, but I don't think people want to hold a bunch of cash, and they're rapidly trying to get us to not hold cash. So I think you're going to see these moves into Bitcoin, into silver, into gold, and into the long bond. And I think that's where you're going to be safest. And for me personally, is that I'm increasingly trying to short NASDAQ, and I am long commodities that you need to live on. And I'm long the precious metals, and I'm very long the long bond of the Treasury. Just remember, when it all collapses, when you see gold and Bitcoin and silver separate from treasuries, then you know we're at the end state.
Mm-hmm.
Until then, the Federal Reserve, the federal government still, that bond is still considered a safe haven. You just saw what happened to the 2-year bond. So, and Phil, if I could just slide over for a little bit for something that's not in here, is that reason why we think this is going to peak here is that for the very first time, I buy 3-month treasuries for our excess cash. I don't know why people are so stupid and have too much money in their bank account. I don't do that. I roll in the 3-month treasuries, and because they pay me 4.8%, but it fell below the discount rate for the first time. So, and discount rate that should be the lowest one out there. So that means there's stress in the system. The bond markets are saying, hey, the Fed's done. Whether they think they're done or not, they're done. And so I think the clock is ticking, and I think we probably have a 6 to 8 month window where risk assets are going to be in big trouble. Doesn't mean they're going to V out of here, because the other thing that Phil's been talking about, guys, remember, is that it's going to take 100 weeks for them to get this ship righted, if you believe historical precedences, and you're going to want to be in the unbanked stuff to protect yourself, and you want to be in risk off, probably to the end of 2024. And there's people out there talking about 2025, we're going to be down to maybe 6 banks. So that's all you need to know.
I believe it. I mean, they're showing us the hand as far as that's concerned. It seems to me they're quite content consolidating all the banks and maybe having a few credit unions sprinkled out as community banks, and that's it. But seems to me that we could potentially be in this mess till February of 2025. And not that we're going straight down the whole time. Nothing goes in a straight line, but as far as getting back to a bull market and getting back on our feet, I don't think that happens until early 2025. Not to say that gold and Bitcoin can't trade higher before then. They certainly can. And that's what they've shown in the past, that they will bottom well before these markets do. And that'll play into the Bitcoin halving, et cetera, et cetera. But yeah, you just have to be prepared that what we've been akin or used to in the last decade, we're going to probably take a little break from that. And this will be a market that a lot of people haven't seen in a long time or haven't seen ever, just because of, how young they are. So interesting times ahead.
It is. And guys, thanks for listening. Hit like, hit subscribe, hit that notification for every time so that you guys can get this information from us. We post 6 times a week, and we try to be as straight on this stuff as we can, and we're looking to keep helping you guys stay wide awake on this stuff. And remember, he who panics first panics best. So you want to be ahead of the crowd. When you get these recognition events, that's when you need to react instead of sitting around and waiting to see what other people do, because once everybody reacts, it's too late. Thanks again. Have a great weekend.
See you guys.
Trade Genius.